derivatives, and then in the end we can do some of them.
So
Okay.
even I have questions in the theory then.
So we should keep doubt solving sessions also. Okay. Um,
So
uh,
let's do it tomorrow for equities.
okay then. Okay. So now we will continue with derivatives only then,
Yes,
and
sir.
then
Yes.
we'll do doubt solving.
Tomorrow
Okay.
maybe.
Okay. Fine. Okay. So derivatives. Yeah. So what we will learn in derivative is what is derivatives. We'll see. Derivative has been categorized into two parts. Okay. What is it? We will be seeing it in some time. It has been categorized into two parts. One is over the counter derivatives. Over the counter derivatives. Another one is exchange traded derivatives. So shortly called OTC. Okay. OTC and ETD. Okay. Now, over the counter derivatives has been further categorized into um, any idea over the counter derivatives? Forward
And futures.
and swaps. Okay, exchange traded derivatives has been categorized into futures and options, and then swaps has been further categorized into uh, credit default swaps, credit default swaps, interest rate swaps, currency swaps, equity return swaps, or equity swaps. Okay, equity return swaps or equity swaps, one and the same. So these are all some of the types of swaps. Then options has been further categorized into call option and put option. Call option and put option. Okay, so this is what we are going to see, plus many more things we'll be seeing. Okay, now the journey will begin from what is derivatives. So what do you mean by derivatives? Okay, so derivative means, okay, so derivative oops, this part is gone. Okay, I'll just quickly write OTC just 1 minute. Hold on. Hello, hello, hello.
Yes, sir.
Yes, sir.
Sir.
Yeah, sorry for that. Okay, now this is OTC derivatives, exchange traded derivatives, forward and swaps, futures and options, and swaps is credit default swaps, interest rate swaps, currency swaps, and then equity swaps. Then here call options and put options. Okay. So now what is derivatives? See, right now if I say, just assume that I have your phone in my hand. Okay. A phone, mobile. Now I'm asking you what is the price of this phone. So let's say you are saying it is 10,000 rupees. Now when I say 10,000, when I say, you are asking me what is the price, I'm saying 10,000. So when I say 10,000, the price is 10,000. So if you want, you can give cash and take this 10,000 rupees mobile from me. This is called as spot transactions. Spot transactions. That means you are doing transactions based on the price that is currently available. That is called spot transactions. Okay. Now case 2. Suppose if I show you one phone and if I say, look, I wish to sell this phone to you 6 months down the line. That means after 6 months. After 6 months. Right now it is 10,000. But after 6 months, I wish to sell this phone to you, and assume for a minute that you are also accepting that, okay, fine, you want to buy after 6 months. After 6 months. So what should be the price according to you? After 6 months, you will pay me money and I will give you the phone. So what should be the price after 6 months?
It will go down. It
Okay.
will depreciate.
Okay, fine. So give me some number then. So let's say it is then 9,000. Okay. Now you said depreciate. So the reason you said, so what have you done? First of all, you have derived the price. You have derive means what? Predicting the price, deriving, finding the new value, predicting based on various reasons. Now you said depreciation, there can be other reasons like technology, new technology will come, new brands may come. Okay, so based on which the price will come down. So what have you done? You have derived the price of you have derived the price of uh, uh, you have derived the price of the underlying asset, that is phone over here. Okay, so deriving refers to what? Predicting, finding the value. Okay, based on the underlying asset. Right now what is the value? 10,000. So because it is 10,000, we have derived that the price should be 9,000. Fine. Now another case, imagine there is gold now in my hand and I'm saying right now the price of this gold is, let's say, 10,000 rupees. Now I'm saying I wish to sell this gold to you, maybe like 1 year down the line. So 1 year down the line, today itself, we are entering into an agreement. Why are we entering into an agreement today? That we will come to know little later. But let's say today we are entering into the agreement. So what should be the price? 1 year down the line, what should be the price of this gold? At what price, if you
It
have
will
to buy
depend on the
from me?
market rates.
So let's agree upon the price now itself. If
10,000.
what do you think should be the price? Today it is 10,000. After 1 year, what do you think should be the price?
7,
It will
8,000.
7,000-8,000. Okay, 7,000-8,000. Fine. Okay, Subhajit, what did you say?
like I thought the price would increase.
The price will.
Increase.
So that is your opinion, right?
So
So
let's
you
say
can
11,000.
increase. So 11,000. So it can go down as well as it can go up, right? So what have we done now? We have derived the price. On what basis did you derive this? So why do you think the price will go up further? There
Like
can be
I
many.
done my own
Inflation.
research.
So what could be the reason why the gold price will go up? It can be, let's say, this
Inflation.
inflation. Yeah, inflation. High inflation will increase the gold price up. Similarly, low inflation will bring the gold price down. That is also possible. Okay. Then similarly, then what else could be the reason? War could be one reason. Geopolitics could be one reason, because of which, the trust towards gold will go up. Then, so during periods of uncertainty, gold price will jump up highly. Like you see, last couple of years after Ukraine Russia war and all, uncertainties went up, and then after Trump took over, like so many uncertainties, that the prices are going up highly now. Okay. So based on this, you can say the price will shoot up. Or imagine everything, peace is there everywhere. So in that case, the price of gold will come down. Okay. So yeah, so these are the reasons why gold price will go up and down, let's say. Fine. So now what have we done? We have derived the price of gold. Okay, we have derived the price of gold. Now what is the underlying asset over here? Gold. Now case 3. Let's say Reliance shares. Now let's say the price of Reliance is 2000 rupees now. What do you think should be the price of Reliance, let's say 3 months down the line? After 3 months,
Say 1500.
1500, you think it will come down? Okay. So you think it will come down. So why do you think it will come down? It may be because of quarterly results. You are expecting bad quarterly results, so Reliance may come down. You are expecting maybe like more competitor for Reliance will come into the market. Okay. Let's say yeah, more competitors will come into the market. So you are thinking that Reliance will come down, or it is rainy season, so overall the demand for goods and services will be low, so because of which the price will come down. So all this could be the reason why you think the price will come down. Now what are we doing now? We are deriving the price of what? Of the underlying asset called what? Reliance. So what do you mean by deriving? Deriving means predicting. Derivation means what? Deriving the price of the underlying asset. Deriving. So derivative means it is a financial instrument. Okay. It is a financial instrument. It is a financial instrument. It is a financial instrument. Okay. Derivative is a financial instrument whose value is derived. Okay. Whose value is derived based on the underlying asset. Based on the underlying assets. So you got the meaning. Basically, you are deriving. That means derivation, when we say derive, it is always about some future date. It is always about some future date. Why? Because right now there is nothing to derive. When I say right now the price of mobile is 10,000, means it is 10,000. Maximum you can bargain for discount. Okay, right now when I say gold's price is 10,000, it is 10,000. Right now when I say Reliance's price is 2000, that means it is 2000 only. There is nothing to derive there. Getting the difference between spot transactions and derivatives? Derivative means you are predicting the future. In future, what will be the price of the underlying asset? That is called derivatives. Are you clear with the meaning of derivatives?
Yes.
Yes.
Okay. Now, if imagine, let's take one example. Let's say there is X and Y. Now, X is the buyer and Y is the seller. Now, they both have agreed to buy and sell gold 6 months down the line. And they both have agreed for, let's say, X said, I will pay you maybe 11,000. Okay. And he has to give gold when 1 year down the line, let's say. So now 1 year down the line, what will happen exactly? X will pay 11,000 and gold will be given to Mr. X. Okay. Gold will be given to Mr.
So I just had a doubt. How do we determine the time period that after 1 year or after 6 months we have to do the transaction?
Now it is happening between A and B, or between X and Y, right? So they both are determining on their own whatever date they want, they may select.
Okay.
Okay. Now in this case, that is the this is how it is. There are other cases also that we are yet to see. So right now it is just two people. It is, you just think that this is you and this is your friend. Okay, you both have entered into a contract. And you said that, okay, let's keep, instead of 1 year, you don't like 1 year. Let's say you want to keep next month. This is June, so you want to keep maybe July, the 30th as the date, expiry date. That is called expiry date, the last date. So can you keep that? Yes. If you both agree, you can keep that. As long as you both agree, any date you can select. Okay, so you don't like July, you want to keep 15th August, keep it, no worries. Okay, is that fine?
Yes, sir.
Okay, now you both have decided. Imagine now 11,000 and 10 and gold will be given after 1 month or 1 year, whatever time period decided. Okay, now this is a derivative contract. Why? Because the price is decided now, but it will be executed at the future date, right? So it is a derivative contract. Now, if this is a derivative contract, okay, if this is a derivative contract, now derivatives are of two types only. One is over the counter derivatives and another one is exchange traded derivatives. Exchange means, it is happening through stock exchange. Okay, exchange traded derivatives. So in this one, what do you mean by over the counter? Over the counter means privately two parties are coming together and they are entering into the contract. That is called over the counter. Over the counter means what? Privately two parties are coming into the contract, coming together and entering into the contract. So what do you think? What type of derivative is this?
Over the counter.
Over the counter, because there is no stock exchange all involved in it. So that means if it is a derivative, it has to be over the counter derivative. Now, if it is over the counter derivative, then it has to be either forward or swaps. It has to be either forward or swaps, because over the counter derivatives are of two types only. Now, whether it is forward or it is swap, we have to see. See, swap means what? Swap means both the sides there will be cash flows. That means you give me some cash, I will give you some cash. That is how swaps will work. Then how is it possible? Why will both the parties agree on cash exchange? That we will see when we reach to swaps. Right now, are we meeting that characteristics here, where both the parties are giving cash? No, right? One is giving cash, another one is giving the underlying asset. So that means this is not swaps. Then what is this? This is forward. So we have entered into a forward agreement. Okay, now what are the characteristics of forward agreement? Characteristics or features of forward. Okay, you can even say OTC also, it is fine. Over the counter contract also, because whatever you speak about forward, it is applicable for OTC as well. Okay, so what are the characteristics? Number one, no exchange is involved. That means no stock exchange is involved. Fine, that is one. Then number two, no exchanges involved. Highly customized. This is what you asked, Shravani. Like, why are they deciding 1 year and all that thing? Because it is highly customized. As long as both the parties are agreeing, any date can be selected. Okay, not only any date, any quantity can be selected. Why only 1 gram of gold? If they both want to get into the contract for 10 gram of gold, 20 gram of gold, 100 gram of gold, as long as they both are agreeing, it is fine only. So that's why it is highly customized. You select any date of expiry, but the only thing is both the parties should agree. Okay, so highly customized one. Customized or tailor-made also you can say. Tailor-made. Then third one, fourth one. High risk of default. High risk of default means what? I'll come to the third one in a while. What do you mean by high risk of default? High risk of default means, see, imagine for example, now today we have entered into the agreement. Okay, X and Y, they both have entered into the agreement that they will execute it after 1 year. In the next 1 year, imagine the price really shoots up. Assume it has gone up extraordinarily high because of all the war, and it has reached to 20,000. Now 20,000 it has reached the price. The buyer has to pay how much? 11,000 only. And seller will give gold. What is the worth of gold in the market? 20,000. So who is gaining and who is losing here? Who is
The
gaining?
buyer is gaining
Why is gaining?
because the market prices are high right now and he's buying at low, right?
Why is selling, right?
The buyer is he's buying at 11,000 and the market price is 20,000 right now. So
Hmm.
he's in profit, right?
Who is in profit?
Buyer.
Buyer is in profit, no? Huh. Buyer is in profit, right?
Yes.
So buyer is in profit. Who is the buyer? X is the buyer, right?
Yeah,
So
it's just
buyer will gain how much? 9,000 here.
9,000.
So now quite possible that at times seller might say, look, I don't want to honor the contract. Do whatever you want. Then what will the buyer do? He will go to the court of law. And that will take like, decades and decades. So the seller knows that, I'm not going to. So moral of the story, seller can default over here. So that's why for Mr. X, there is a high risk of default. This is okay. If the price really goes up, Y can default. Chances are there. This is okay.
Yes, sir.
Okay.
Yes.
Now case 2. Instead of price going up, imagine the price has come down to 5,000. Now, anyways, the agreement is for 11,000. So buyer has to pay 11,000. Now, who is gaining and who is losing?
Like buyer is losing
Buyer is losing. Why? Because he has to pay
Okay.
11,000. Okay, he has to pay
6,000
11,000.
for loss.
So he has to pay 11,000, but its price in the market is only 5,000. So he is losing 6,000 rupees. That means in a way, that means seller is gaining 6,000. Why? Because he has sold for 11,000, whose price in the market is only 5,000. Okay, now suppose, but in that case, buyer might default. Who knows? So that's why for both, there is high risk of default. Is this okay?
Yes, sir.
Okay. Yeah. So now how do we mitigate this risk? Any thoughts coming to your mind? Can we have a case where, one party, let's say buyer, is paying advance payment to the seller? Can we
And
do
there should
anything?
be an intermediary.
Yeah, or there could just be like a regulatory body.
So far, there is no regulatory body now here. Correct. What you said is right. Now, let's assume that Y says, look, X, I don't trust you. You have to give me some advance payment. let's say something like 3,000 advance payment. Will that work out?
Yes, but there's also chance that Y could also default.
Correct. So if you are Y, what will be? So if let's say if you are X, okay, and Y is asking you to pay 3,000, what will be your argument? What will you do?
Giving some quantity in advance, like asking X will be asking for some quantity in advance from Y.
And what will be the value of that quantity?
Maybe equal to the amount that is paid.
Yeah, 3,000 only.
So now you think nobody will default?
No, still they can default.
How?
Like, uh, like
They
let's
could
say,
Is
just
this is
not.
this is this reducing the risk now?
no, it's not reducing because
They could just
they've
not
just
honor the
exchanged the
contract
value.
further.
Yeah. See, it is not reducing the risk. So even instead of gold, if he takes cash also, it is not reducing the risk. Why? Because they both have each other's 3,000, 3,000. Okay, and it is not possible that only Mr. X is paying to Mr. Y. Because X will say, like, I don't trust you, you also give me money. Just like you don't trust me and you are asking money from me, even I don't trust you, you also give me, and you also give me 3,000 only. That means the risk will stay there only. So that means moral of the story, this advance payment is not possible here. Okay, regulators all we will see then. Those are all further development happened. But right now in this case, advance payment is not possible. So technically it is called as no initial margin. Now because there is no initial margin, so there is high risk of default. Is this fine now? Because there is no initial margin, there is high risk of default.
Yes.
Okay. Yeah. Then next one, physical settlement. What do you mean by this physical settlement? Physical settlement means on the day of expiry, Mr. X will actually pay cash and Mr. Y will actually pay the underlying asset. Now you might wonder, like, yeah, but that's how it is supposed to happen. Yes, but it can be settled in other ways also that you will see in some time. This is called physical settlement. Physical settlement means where the underlying assets will be actually delivered. The underlying asset will be actually delivered. Okay. The underlying asset will be actually delivered. Fine. Okay. So these are some of the characteristics. Now, see, what do you mean by business now? Business is all about creating a product and then selling it to the public. That is business, right? And then what happens in business? And then they will further innovate, and further they will find out loopholes in the existing product, and then they will further innovate, and then they will give you a new terminology to that new product, and then again sell it to the same public. That is what business is all about, correct? Innovate, make the product better, give you a new terminology and sell it. Like for example, we had landline phone long back. So what was the drawback of this landline phone? The drawback was
Connection
it
providing.
was it was immovable, right? You cannot take that phone in your hand
Yeah.
and you cannot move out. So if you are outside your home, you cannot connect with your family members. So this was the loophole. So they brought what? They changed, and then they brought what? Mobile. Okay. Now then they thought, then again sold to the same public. Then further they thought like how to add more value. Then they started, having messages. So message, and then they started having cameras. So camera phone. They started bringing camera phone. And then, further they added internet, video call, and all that. Now it is called as what? Smartphone. Smartphone. Okay, so this is, yeah, smartphone. So you see, you add values and then change the terminology and again sell it to the same public. That's what innovation and business is all about, right? So similarly here also innovation started happening. Now out of all these characteristics, if you want to change one thing, what would that be? One characteristics that you don't like over here.
High risk of default.
Yeah. So that is very discouraging, right? High risk of default. Because that is, if there is high risk of default, you might not even enter into the contract first of all. Okay. So people started thinking how to reduce this risk. So how to reduce this risk? As you said, third party should be involved. Now the question is, who is that third party? That third party should be a trustworthy party. So they brought in, exchange at that time as the third party. So when they brought exchange, so it worked like this: X and Y, they don't trust each other. Okay, bring the exchange in between. Now how will exchange work? Now exchange said, okay, they will, when X is entering into the contract, he will pay some initial margin. Mind you, before this there was no initial margin. Now he will pay some initial margin. Similarly, he will also pay some initial margin. Okay, initial margin. Now they both are paying initial margin. That means exchange can control both X and Y. Exchange can control both. They both are paying initial margin. So now what will happen? Now exchange is taking the counterparty guarantee. So exchange says, like, you don't worry. Now look, X, you don't worry about Y. I will take care of it. And exchange says to Y that you don't worry about X. I will make sure that the deal, properly is honored. So this is how, now the risk is reduced. Okay. But when it was introduced, see, and when it's, when it was introduced, now exchange is an online platform. So exchange said, look, I will help you in reducing the default risk, but then my system is open for everybody across the country. So many people are going to participate. Now, when many people are going to participate, I will have to standardize things. That means my platform is only for certain commercialized products, not for anything and everything. Like, for example, when X and Y are privately entering into the contract, they both can enter into the contract for pen, pencil, eraser, sharpener, gold, silver, copper, iron, anything that whatever they like. But then here in this one, they said we will support only for highly commercialized products like gold, silver, or or Reliance, large cap companies like Reliance, Infosys, ICICI, like this. And also they said that under our platform you cannot keep any date as the expiry date. So they decided that in India, last Thursday of the month is considered as the expiry date. Last Thursday of the month is considered as the expiry date. Okay, so last Thursday of the month is considered as the expiry date. Okay, so yeah, is considered as the expiry date. So like this, they started standardizing. So now you see no exchange is involved, getting changed now. It is getting changed to exchange is involved. Exchange is involved, which I should write here down. Highly customized got changed to standardized, highly standardized. Okay, why standardized? Can you understand? Okay, because the service has been standardized. Example, in terms of expiry date, in terms of quantity, also in terms of the product, also it got standardized. Okay, it is like, see, customization, standardization, it's like, imagine you are going to your home, and then you feel like eating biryani, so you will ask your mom, and then they will prepare, and then they will give it to you, right? So that is customized services we are getting in our home. But when you go to a hotel, what will happen? Before you even open your mouth and ask anything, they will give you the menu. What does that mean? That means don't ask whatever you feel like eating, select from the menu only. That means what? Standardized services. It is standard. Fine. Okay, already decided, standardized, from there only you have to select. Then no initial margin. Here what will happen? Initial margin. So everything is getting changed. Just like phone. What was the purpose of phone? The purpose of phone is what? So that we talk to the family members when there is a need. And now what are we doing? We are hardly using phone for talking. We are using more, often phone for social media stuff, and WhatsApp chatting and all these things we are using. So now purpose itself is getting changed now, right? Okay, similarly here also, it is getting changed now. So many things are getting changed. High risk of default becomes low risk of default. Physical settlement, cash settlement. What is this? I will talk about it. Cash settlement, I need to talk. Okay, now when so many changes are happening, now I have to change the terminology also, no? Then so they gave you new terminology. What is this terminology? Futures. And these are all the characteristics of futures. So from forward, now we are jumping to future, exchange traded derivatives. So all these are characteristics of futures or exchange traded derivatives. This is okay?
Yes, sir.
Yeah. So this cash settlement, let's discuss that one now. First of all, before that, why did forward come into existence? Why did forward come into existence? Okay. So why did forward come into existence? That means X and Y agreeing to buy gold after 3 months. Why are they agreeing to buy after 3 months? If they are interested to buy after 3 months, then why are they entering into the
Because
contract today?
X may not have the money right now.
He doesn't have money right now.
Yeah,
Okay.
that could be.
Then whenever he gets money, that time he will buy. What
Or
is
he
the need
thinks
to?
he's speculating.
Okay.
He
Okay.
thinks that the price would go down in the coming months.
Ha ha ha. Yeah. Okay. Yeah. See, why would somebody enter into the contract? Initially, it all came up because of the need, right? Necessity is the mother of all invention, right? So, how it came up is, uh, okay, say see, let's say this is a hotelier. Now, this hotelier, this is ITC or Taj Hotel, something like that. And so what is their risk in their business? That the any big, this is a big hotel chain, think like this. So the risk involved in their business is that food price can go up anytime. Okay, or think a normal hotel where too many people are coming to eat. So what is the risk here? That vegetables price can shoot up highly. Okay, vegetables price can shoot up highly. That is the risk. Just imagine, you can see around, right? Onions price goes beyond 100 rupees. Tomatoes price at times goes beyond 100 rupees. And these are all essential ingredients in cooking, right? So it really impacts his business, because he cannot keep on changing his meals price every day. Then the public, his customers will leave him. So that is the risk in his business. Now imagine on the other side, there is a farmer. What is the risk for a farmer? Farmer doesn't know what will be the price of the crops that he is going to produce now. In 3 months, his crops will come up in the market, but he doesn't know what will be the price. At times, the price will be as low as 10 rupees also. So he might not be able to recover the amount that he has invested. So now what to do now? So what to do is, okay, so these are the problems. So this hotelier is approaching the farmer saying, look, after 3 months, I will buy onion, tomato from you at 50 rupees. Because he knows that at the rate of 50, he can sustain his business. And farmer also knows that at the rate of 50, even his business will go on properly. So farmer also agrees to deliver what? Tomato or onion. So this way, what is happening? This way, they both are getting security from each other, as in their business is getting secured. Okay, so this is called as what? Hedging. Hedging means entering into a new contract in order to reduce the risk involved in your original business. What is their original business? Hotel and farming. They both have their own risk in that business. So in order to reduce that business, they both are entering into a new contract. Okay, you understood this one, why they are entering into? So why they are entering in advance today itself, when they require onion 3 months down the line. Is this clear? This is called hedging purpose.
Yes, sir, clear.
Okay, yeah. Another example I can give is, imagine Kalyan Jewelers. So Kalyan Jewelers. Now what do? The jewelry company, right? So people go and buy jewelry. So now, what is the risk in their business? That gold price may shoot up highly, and that will impact demand. So they may get in touch with the gold mining company. Okay, they may get in touch with the gold mining company. Okay, and they say they may enter into the contract in advance that, look, after 3 months I will give you, let's say, 10,500, and you have to give me gold. So doesn't matter whether now after 3 months whether the price goes to 11,000 or the price comes to 10,200. They both, because they know at 10,500 they will be able to sustain their business. So the intention here is to sustain their existing business, original business, not to make profit or loss in this case. So such transactions are what? Called hedging. Hedging means entering into this transaction in order to just reduce the risk involved in the original business. Is this fine? Couple of examples for hedging.
Yes,
Why forward came into existence. Okay. So that's how forward came into existence, for hedging purpose. Okay, I can give you another example also. Say for example, Infosys. Not Infosys. Let's say there is some importer in India. Now he is importing from US. This is the exporter. And this is India, importer. Now, when importer is importing, he says, give me 3 months time. After 3 months, I will make the payment. So $100 he is supposed to make the payment. He is importing goods and he is supposed to make the payment of $100. Okay. $100. So $100. So he is supposed to pay. Now, what is his worry? His worry is $1 is equal to, imagine, 80 rupees today. So $100, if he pays today, it will be 8,000 rupees. But his worry is, what if $1 becomes 85? Then what will happen in another 3 months? Then $100 will be 8,500. So he has to pay 8,500 after 3 months to get $100 and to repay to the exporter in US. So he is sensing some risk. So what will he do? So this importer will get in touch with an investment bank. And he will say, look, after 3 months, I will pay you 80. You have to give me, or 8,000. You have to give me $100. And then taking $100, he will give it to these exporter. Is it okay?
Yes.
Okay. These are all the reasons. Now the next concept is mark to market. There you will understand cash settlement. Okay. Mark to market. Mark to market. Shortly called MTM. So what is mark to market? Okay. See, now X and Y. This is the exchange. Now imagine the price is 1,000 rupees. They both have entered into the contract to buy and sell for 1,000 rupees. Okay. Let's say in few days. Now in few days, in a week's time. Okay. We'll take it very short time duration here. Now imagine X has to pay initial margin, right? So assume 30% is the initial margin. So he will pay how much? 300 to the exchange. Y will also pay 30% to the exchange. Okay. Now, today at let's say 10 a.m. they have entered into the contract, and at 3:30 it has gone to 1,020. Okay. So now tell me, who is at benefit now? X or Y? X is the buyer, okay, and Y is the seller.
Buyer is at profit.
Yeah, by how much?
20
By
rupees.
20. Okay. Now today only it is happening. Today is 3:30 p.m. So because everything is electronized, tomorrow morning when Mr. X wakes up, what will happen? This 20 rupees would be credited in his bank account, in his margin account. It will be credited. 20 rupees will be credited. Now, if 20 rupees will be credited to his margin account, now this money is not coming from the sky. It has to come from somebody's pocket. Now, who is that somebody? That somebody has to be Y. So, because Y is the loser in this case, so 20 rupees will be debited from his account. This is okay. This calculation is fine.
So does that mean that every time the price goes up, the seller will have to debit money from his account?
Yes. From his account, automatically it will be debited by the exchange. Okay. Now next day, imagine it goes to 1030. Now what will happen? Tell me.
Buyer will gain again.
Gain how much?
10 rupees more.
10, because for this 20 already effect have been given. So 10. And this is minus 10. Okay. Now, every day the market may not go up. Let's say next day it has come down. Now who is gaining?
7.
Okay.
Seller, so 5 rupees.
5 will
That's
be
two
added
to
to
buy.
the seller and 5 debited from the buyer's account. Okay. Then again, let's say it goes to 1050. Then plus 25 minus 25. Let's say this is the expiry date. It's over. Expiry. Now, once it gets expired, till the expiry day, this keeps on happening. Once it gets expired, then what will happen? Let's see what will happen. So here, just calculate all this. How much is it coming to?
It's 250 for seller.
250 for seller.
Yeah.
So, and the buyer calculate.
It's 350.
350. So that means seller has lost 50, right? And buyer has gained 50.
Gain 50.
And you can see here as well. From 1000, it has gone to, see, if I do only on the last day, if I do calculation, it will do the same thing only. Okay, between the first day and last day, if I do, it is going to do the same thing. But what is happening here? Every day it was calculating. So this calculation of profit and loss every day based on the underlying assets closing price is called as mark to market. So what do you mean by mark to market? Mark to market is the process of, so mark to market is the process of calculating profit and losses. Okay. Mark to market is the process of calculating profit and loss on daily basis based on the is the process of calculating profit and loss on daily basis based on the closing price of the underlying asset. Of the underlying asset. Okay. Clear with this term mark to market?
Yes, sir.
Yes.
Okay. Now let's see some other observation here. See the observation. You came in with 300 and you are going away with 350. The seller came in with 300 and he is going away with 220. So practically nobody gave 1,000 to anybody. And the deal is over as well. Contract got expired also. And nobody got 1,000. And they both, are fine with it. That means, this is called what? This is an example of cash settlement. Cash settlement means what? The loser has to pay the winner only the difference. Whatever he is losing, that only he has to pay. This is the amount he is losing. So only that much only he has to pay. Okay, that much only he has to pay. So that's why it is called as cash settlement. You understood the meaning? Cash settlement means paying only the difference. The loser will pay to the winner. Not like entire product has to be given. Is it fine?
Yes.
That is the beauty of this product futures, and that is the reason you don't have to own the underlying asset over here. That means if this is Reliance, I don't have to own Reliance to say that Reliance will come down. It is like, imagine you are let's say you believe you are let's say you are a fan of let's say Mumbai Indians, and you don't want some other, let's say Delhi something cricket will be there, right? These clubs are there, correct? Like this, which is the other one apart from Mumbai Indians?
Chennai Super Kings.
Chennai Super King. Okay, so let's say you are a fan of Chennai Super King, Mumbai Indians. Now you want to predict that Chennai Super King will lose. Okay, so so they both are playing, and you are predicting that Chennai Super King will lose, or you are predicting that Mumbai Indian will win. You do not have to own Mumbai Indians to predict about Mumbai Indians. You do not have to own Chennai Super King to predict about Chennai Super King. Correct? You understood? Are you able to relate this? In cricket match and all, when we predict, and if you enter into an agreement with anybody, you don't have to own it. Only your prediction should be correct. If your predictions are correct, you will be rewarded. Okay. That's why it is called as what? Cash settlement, where the underlying asset is not exchanged. Are you able to get this one?
Yes.
Yes,
So these
sir.
are like lots, right? One lot is for 300, and then how much ever one can
Here I have done only for one share,
one
but
share.
practically it will be traded in lots.
Okay.
Okay. Lots means, Shravani, lots means what, it is like, imagine, as I said, standardization. It is an example of standardization. Lots means what? Imagine you want to buy a, imagine you want to eat only 2 pieces of biscuit. Now, what will you do when you go to the shop? You will say like, give me 2 pieces of biscuit, or you will say like, give me one Parle-G packet.
RDG
Packet. So that means, moral of the story is, you have to minimum buy 1 packet. It will not be sold in pieces. Minimum you have to buy 1 packet. You may buy 2 packets and eat. You may buy 3 packets and eat. But minimum 1 packet you have to buy, and 1 packet may have 10 biscuits, let's say. Similarly, when this exchange came in, they said like, we cannot enter into the contract for 1, 2, 3, 4 and all that thing. We will be, selling all in lots only. Lots means what? One company may have 100 share as one lot. Another company may have 1,000 also as one lot. That depends. Okay, some will have 250 as one lots. Okay, that is lot size. It is called lot size. Means one lot will have 10, like some biscuit packet will have 20 also. Some may have 15, some may have 12, some may have 8, 9, right? Similarly, here also different company shares will have different lot size. That means it may represent, one lot may represent 100 shares. Okay, then you can either go for 1 lots or 2 lots or 3 lots. Here I have taken all for only 1 share to simplify things, which is enough for this subject. It is enough. Any doubt on this so far, whatever I have spoken?
No, sir.
No, all okay? Fine. So cash settlement is also fine, right? Okay. Yeah, so forward futures. Okay. And mark to market we have done today. Okay, sure. If you are not tired, I will continue for 15 minutes more. Or if you're tired, then we can stop now here also, because it is a technical subject. If you're tired, you are free to tell me. And if you're not tired also, feel free to tell me, so that I can continue as well.
Yes, sir, we can.
Continue. Okay, fine. Okay. So now next innovation, forward futures. The next innovation is another characteristics before going to the next innovation. See, in forward, buyer is supposed to buy on the expiry date and seller is supposed to sell ideally on the expiry date. That is called as obligation for both the parties. Obligation for both the parties. Obligation for both the parties. Here also in futures, ideally, they both have to abide by the rules, and they both have to see this one buy sell happens, and they both have to take profit and losses. So that is also obligation for both the parties. Obligation for both the parties. Then next one, forward futures. Then so further innovation. So what is the further innovation? Now, they thought here, when we look at the characteristics, it's an obligation for both the parties. Obligation for both the parties. Then they thought, can we create a contract where one party do not have the obligation? He will have the right, but not the obligation. So what does that mean? How does that work? Let's see. Let me give you one hypothetical example first of all about real estate, so that you can relate it better. So let's say there is a buyer X and there is a seller. Okay, buyer and seller. Now buyer says, look, I like your home. If at all I decide to buy, I will pay you, maybe this is, let's say, 10 lakhs. I will pay you 10 lakhs. But then, so the amount is decided. However, decision is not decided. What does that mean? Whether he will buy or not, that is not decided yet. Decision is pending. Okay, that means Mr. X says, look, I will contact my parents. I will seek their guidance. If they agree, I will pay you 10 lakh rupees. Amount is decided. If they agree to buy, I will pay you 10 lakh rupees. Okay, this is what Mr. X says. And if they don't agree, so that means now Mr. But then he, X says in case if they agree, then X has to sell. Okay, now he says, buyer says, give me 1 month's time. Now, if you are Y, what will be your argument? So buyer says amount is decided 10 lakhs. That is all fine between X and Y. But he says, first I will consult with my parents. If they are okay, then I will pay all 10 lakhs and I will buy from you. Give me 1 month time. If you are Y, what will be your argument? No argument. No argument, nothing.
Sorry, sir, could you repeat?
Yeah, see, now the buyer says, buyer has agreed, that I am ready to pay you 10 lakh, but give me 1 month's time. If my parents agree to buy, I will pay you 10 lakh. That means amount is decided. But will he buy or not? Decision is not decided. So buyer says, give me 1 month's time. And then I will decide. So, but in case if I am buying, you should not say no to it. You have to sell. Okay, this has been told to you. You are the seller. What will be your counter argument over here?
Like I'll ask him for advance.
Okay, yeah, but then he has said like there is no guarantee that he is going to sell. He is going to buy.
So even if
So
he's not buying, I'll still have the advance with me.
okay, okay, fine. But then what will you do with the advance then? Later on, if he says I don't want to buy, then what will you do?
I'll keep it with myself.
Acha, still you will keep it with yourself. Okay, fine. That is fine. Okay, all right.
Like that's how it
See,
works, right?
yes, yeah. So now imagine over here, based on whatever I told you, what you should say is like, why you will say like, look, what is this? I'm waiting for one entire month and there is no guarantee that you are buying. And at the end, if you come back and say like you don't want to buy, I'm getting nothing out of this. Okay. So now the buyer says, okay, don't worry. I will pay you 10,000. This is your waiting charges for the next 1 month. Okay, waiting charges means risk taking because seller is only waiting, right? So he says this 10,000 is for you only, irrespective of whether I buy or not. Okay. So if I buy, I will pay you 10 lakh more. If I don't buy, that's it, all gone. You keep this 10,000. So this is how equality is created. Equality is created between the buyer and the seller. You got the idea here? That means in this contract, this buyer has the right to buy, but not the obligation. Has the right to buy, but not the obligation. Okay. Has the right to buy, but not the obligation. Okay. So is this fine? Is this fine? He has the right to buy, but not the obligation. Now let's replicate in the derivatives market. See how it works is here there is X, there is Y. Now this person, he says, imagine instead of 10 lakhs, let's change it to 1,000. He says, if at all I buy, I will buy it for 1,000. But will I buy? No, I have not decided yet. So amount is decided, but then will he buy or not? That is not yet decided. So, so now what will happen here? So buyer, so why will say like, look, why is taking all the risk over here? How? Because Now imagine this is 1 month contract. Now in the next 1 month, imagine the price of the underlying asset has gone to 1100. Then he will buy for 1000 because price is already decided for 1000. So he will get 100 profit. And if the price comes down, imagine maybe 950, then he will say like he doesn't want to buy. So he's safe. So in both the sides, Y is only taking all the risk. So the question is like, Y will say like, why should I take all the risk? Y is the seller. So what will Mr. X do? X will say like, hold on, wait. I'm ready to give you, let's say, 100 rupees. Okay, or 50 rupees. I'm ready to give you 50 rupees. This 50 rupees is your risk taking charges. Remember, buyer is taking the right to buy. Right to buy means what? He may buy, he may not buy. He may buy, he may not buy. Okay. Buyer is taking the right to buy. He may buy, he may not buy. Okay. So if he doesn't buy also, because imagine the prices come down, still he is not wrong. Why? Because he has taken the right to buy. He has got the right to buy. Okay. So till here is this fine? So if the
So, but
price
isn't the seller at loss here because the price is settled at 1000, but he's only getting 50?
so it looks like, okay, seller seems to be like a fool kind of person, right? Okay, so that we will discuss that also. But otherwise, all points are clear. Whatever I have told,
Yes.
all points are clear. Now it looks like still the deal is all tilting towards buyer. That we will see finally. Who gets more amount here. Right now, buyer is getting all the right to buy. Okay, so if he wants, he will buy. If he doesn't want, he will not buy. So in that case, what is the maximum loss for the buyer? Maximum loss for the buyer is only this 50. This 50 is technically called as premium. So buyer is paying premium to the seller. Because if it goes up, imagine if it goes to 1000, imagine it has gone to 1200. So he will buy it for 1000, whose price in the market is 1200. That means he will get 150 in that case. And 150 he will get, out of which 50 is already paid. So net his profit will be 100. And that net profit will be paid by Mr. Seller. And in case if the price goes to 950, then what will the buyer do? Buyer will say, I don't want to buy it for 1000.
He won't execute it.
He will not execute only, and so he is going to lose only 50. Is going to lose only 50.
So your buyer's maximum loss is 50, right?
Yes, buyer's maximum loss is 50. If it goes 900, still he will not execute because
Yeah.
he wants the price to go up. Anything beyond 1000 only he is going to execute. Okay, anything lower than 1000 he will not execute. Okay, so this buyer is called, he is also called the holder. There are many terminologies, okay, in this subject. Derivatives is full of terminologies and you have to know all those terminologies. Okay, holder, buyer is called as the holder, seller is called as the writer. Okay, buyer is also called as long and seller is called as short. And this option, this is called option contract. Option, why? Because it has been named after the buyer who is having the option to buy. It is up to him whether to buy or not to buy. So it is called as option. Under that it is called as call option. Call option. So call option, what do you mean by this call option? Call option means what? Call option, because it is happening all through exchange. So call option is an exchange traded derivative contract. Okay, call option is an exchange traded derivative contract which is giving the holder the right to buy the underlying asset. Okay, right to buy the underlying asset at the strike price. This is called strike price. Okay, on the expiry date. Okay, on the expiry date. On or before also you can say. So I'll just write down quickly. So call option is the exchange traded derivative contract which gives the holder the right to buy the underlying asset, which gives the holder the right to buy the underlying asset on the on or before the expiry date. This we will talk about it some another day. This line, on or before the expiry date. Okay, call option is the exchange traded derivative contract which gives the right, that means right to buy the underlying asset on or before the expiry date, on or before the expiry date at the strike price. Okay, this is call option. Okay, so let's do some exercises here to see if you have understood better. That is X, that is Y. 100 is the strike price. Strike price means agreed price between them. This strike price is also called as exercise price. Shravani, I'll come to your doubt, okay? So here premium is, imagine, only 5 rupees premium. Okay. Now suppose if the price goes to 130, okay, always remember he is the buyer. In call option, buyer wants the price to go up, so he will execute only if the price is going beyond 100. Okay, and seller anyways does not have any rights. Seller only has the obligation. So he is the writer, he has the obligation to sell. Obligation to sell. So now tell me, what is the net profit for the buyer?
25.
Yeah, 25. Shravani, you understood this 25?
Yes, sir.
Okay. What if the price is 128? Now?
23.
Yeah, 23. 28 is the profit minus 5, 23. What if it is 126?
21.
Yeah, 21. What if it is 106?
1.
1 rupee.
Okay. What if it is 105?
No, like it's BEP, right?
Yeah, correct.
No profit. So
Yeah.
like here also we call it BEP. Or
Break even point. It will be called as break even point. Okay. So 105 will be called as break even point. No profit, no loss. So if I have to articulate it, break even point is equal to, this is strike and this is plus premium. Strike price plus premium. Okay, strike is what? Strike is 100. Premium is 5. 105 is the break even point. This is okay till here, fine.
Yes, sir.
Okay. Now, what if it is 104? Then
I think he won't execute it, right?
No, he will execute. See this arrow mark. Anything beyond 100, he will execute.
Then 1 rupee ka loss.
Ha. So when he executes, he will make 4 rupees profit. But he has already paid 5, no? So his net, he will be incurring 1 rupee loss. In other words, the writer will incur 1 rupee gain.
So, but it's up to him, right? Like whether to execute or not.
He will execute, right? It is up to him, but he will execute. Actually, it is practically system generated. Everything system only will do, but the system will do whatever is good for the buyer. See, imagine if you have to take a decision here, what decision will you take? If you don't execute, your loss will be 5 rupees. And if you execute, your loss will be 1 rupee.
1 rupee, sir.
So what will you do?
Yes, I'll execute.
Execute.
So that's what the system will do automatically. It will be executed. Okay. Now, what if it is 102? What will tell me what is the
3.
profit and loss for the
3
writer?
Writer. So the writer is the seller, right? It's 3 rupees profit for him.
Yeah, correct. See, whatever is the profit for the buyer is the loss for the writer, and vice versa. Whatever is the loss for the buyer, profit for the seller. So even if the question is for the writer or the seller, you focus on the buyer only, and then you take the opposite. Like here, here. To imagine here 2 rupees profit is getting, but he paid 5, so 3 rupees loss. If he is losing 3, the writer will gain 3. Is it fine? Okay.
Yes, sir.
Okay. Then 101 also. Okay, 101 means how much will the writer gain or lose here?
4 rupees, right?
Yeah, correct. Okay, 1 rupee is the profit for the buyer and 5 he paid. So 4 rupees is the loss for the buyer. So gain for the writer is 4 rupees. What if it is 100?
5 rupee profit for the seller and loss for the buyer.
Yeah. Now you see this arrow mark. If it is the price is going up, then only it will be executed. Price is not going up, so he will not execute. So all 5 rupees will be kept by the writer.
Okay. So at 100, he won't execute it.
Yeah, he will not execute. That's why I have drawn this arrow.
Okay.
Okay, and what if it is 99?
He won't execute it.
He won't execute. And so what will be who will be at gain or loss?
Seller will be at profit.
Yeah, correct. At 95.
Again, he won't execute it.
90?
No, like anything below 100, and then it won't be executed.
Yeah. Okay, understood till here then?
Yes.
Okay,
Yes.
now coming to your question, Shravani, that was a good observation. You said like still it seems like everything is tilted towards the buyer because he is hardly getting 5 rupees. That's what you were thinking is, right?
Yeah.
Yeah. See, if you check the data, you will know that writers only gain more in the market than the holders. Okay, why so? Because, see, actually for the buyer, when will his profit begin? Immediately after 101 or after 105?
After 105.
Yeah, till 105, what is he doing? He is just recovering his losses. Correct? Till 105, he is recovering the loss, right?
Yes.
If it goes to 102, he's still making loss only. Net loss. 2 rupees profit, 5 rupees he paid. So net is what? -3.
Yes.
So after 105 only, he is going to get profits. So now let's see what are all the possibilities. So what will happen in the market? Market will be extremely bullish or mildly bullish or staying there only. or mildly down or extremely down. So 5 chances. You are the buyer. So when will you get profit? Only if it is crossing that break even point. That means the market should be very highly bullish. Okay. And so that is one chance when you can gain. But if the market is just mildly bullish, just mildly, that means it has gone from 101 to 3, 4, okay, or even 5, and then it has come back. Then that means it's of no use for you. So this one is favoring whom? The seller. This is favoring the buyer. This is favoring the seller. This is completely favoring the seller. This is also favoring the seller. This is also favoring the seller. So if you see the probability, it is like 1 out of 5. 1, 2, 3, 4, 5. So that comes to what? To 20% hardly. So hardly, probability perspective, it looks like, see, it looks like structure perspective, everything is tilted towards the buyer. But probability perspective, it is tilted towards whom?
The
Seller.
seller.
So seller has 80% probability. And that's why very often the writers only make money in the markets. Okay, but it looks like with the structure that the game is tilted towards the buyer, which is actually not the case. And that's why you see, based on the structure only, many people enter into the derivative market as a buyer. And then what is their story? They will say like they have lost money because the probability of success is very less. You got the idea?
Yes, sir.
Okay. Okay, fine. I think beyond this, it will be too much. So what you do is you revise this very well. I have also, done YouTube video on all these things. So what you people do is in your free time, you may even watch all those videos. You go to the playlist, you may watch this also, you may watch that as well. In case after watching this, still if you feel like, getting more information in advance, you may watch put options and all other videos also. You go to the playlist of my YouTube channel and then start watching there as well, so that when I will come and train you here, it will be little easier for you, because this is
You'll
a
post this one as well, right?
huh.
Yeah. Will you post this one, this
Yes,
video?
yes, yes, yes. I will be
Okay.
all videos, whatever I'm recording now, I will keep sending it to you. I'm saying beyond that also, if you feel like watching any videos, it is already there in my YouTube playlist. You go there and you can watch that as well. And this one also, I will be now itself, I will put it up in the YouTube and then I will send you the link. Okay,
Yes.
fine. And then next time I will just then give you some writings and all. Now I think it will be too much of technical stuff. Next time again I will do some writings like how to articulate for forward, futures. Right now I told only for call options, right? Then put options, all those things I will tell you. And then we'll do some recap, because these are all technical things. Now it is extremely important for this options to be very clear, because this option will keep continuing now. So that's why more and more you do practice, it is better. Okay.
So tomorrow are we doing equity doubt solving?
uh, yeah, we'll do equities first, and then we can go for derivatives. If we
Okay.
get time, we will go for derivatives. Otherwise we will sort out equities.
Okay.
Okay, fine. Because once we get doubts, it is better to sort it out sooner rather than keeping it pending, right?
Yeah. Sure.
Okay.